This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 451 was produced on October 24th, 2024. I'm Eric Townsend. Santiago Capital founder Brent Johnson returns as this week's feature interview guest. We'll discuss foreign demand for U.S. Treasuries, Brent's outlook for the dollar, equities, precious metals, energy, and much more.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, October 23rd, 2024. The December S&P 500 futures down 83 basis points, trading at 58.38. Markets stalling out along the highs as we get into the heart of earnings season. We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The U.S. dollar index up 87 basis points, trading to 104.42, continues to bullishly trend for the fourth week in a row. The December WTI crude oil up 54 basis points, trading at 70.77. Bearish news continues, but oil seems to be holding support lines on each dip. We'll take a closer look at that chart in the postgame, and Eric will have the EIA inventory data. The December RBOB gasoline flat on the week at 201. December gold contract up 219 basis points to 27.50. The move has been robust, but has gold gone too far too quickly? Copper down 92 basis points, trading at 433. Uranium down 84 basis points, trading at 82.55. And the U.S. 10-year Treasury yield up 16 basis points, trading at 420. Now 65 basis point rise in yield since the Fed pivot. The key news to watch next week is the U.S. advanced GDP, the Bank of Japan monetary policy statement, the core PCE price index, the jobs numbers, and earnings on many of the Mag 7 stocks and more. This week's feature interview guest is Santiago Capital founder Brent Johnson. Eric and Brent discuss the U.S. dollar, treasuries, precious metals, and more. Eric's interview with Brent Johnson is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Santiago Capital founder Brent Johnson. Brent prepared a slide deck to accompany today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, MacroVoices.com, click the red button above Brent's picture that says looking for the download. Brent, it's great to get you back on the show. Something you and I have been talking about for years is the long-term plight of the U.S. dollar, and particularly whether or not any realistic threat is posed to it by the alliance of nations known as the BRICS, Brazil, Russia, India, China. I think it originally was South America there, but there's been quite a few kind of BRICS plus that have been added to that. Other countries joining that kind of anti-U.S. dollar bloc. It was laughed off in the finance community when it first began. How's that headed? What's that story look like? Is it something that we need to worry about?
Well, it's something that I've always followed and I've always found interesting, but I am probably, to be fair, one of the people that have somewhat laughed, not at the BRICS themselves, but at the people who think that just because the BRICS countries get together once a year, throw a big party and talk about doing a lot of things, that automatically means that the dollar is done and, the days of American hegemony are over. One of the things I like to point out is that, for everybody that thinks that the BRICS are going to launch this currency and some kind of a basket of their currencies, maybe add some gold or oil to it, you can do that right now. Go buy all, 5 of their currencies, buy some gold, buy some oil, and you've got the BRICS basket. The problem with that, while gold has done phenomenally well, oil has kind of gone sideways for several years, and the BRICS currencies have all fallen 50% or more versus the U.S. dollar, with the exception of the yuan, which has only fallen a little bit, and that's because it's a pegged currency. So, I think people get a little overzealous in the rise of the BRICS, mainly because I think many people want to see the fall of the American empire. It's definitely an area that needs to be taken seriously and looked at. But you just because there's a headline that says they are thinking about doing something doesn't automatically mean they're going to be able to successfully do it.
Well, I think that begs an important question. One thing I'm in very strong agreement with is those BRICS nations, regardless of the question of how much influence they do or don't have, they very much do want to bring about a fall of the U.S. dollar. It's not speculation. They've been perfectly clear in their messaging saying, we think the problem in the world is that the U.S. government gains too much power from its status as reserve currency. We're going to do something about it. Now, it's very clear from what you just said, you're not bought into the idea that, they're going to push a button and make the dollar crash. Do you think they do have a long-term influence that is meaningful and important enough to pay close attention to? And if it's not crashing the dollar, what is it?
Again, I think there's a difference between are these important, meaningful, influential countries and can they crash the dollar? To me, those are two totally different things. They're absolutely important, influential countries. You look at the population that is in the BRICS, and it's a huge percent of the overall population. You add up all the GDP, it's a significant amount of economic growth and power. But again, the transition from a system where the dollar is entrenched in global commerce, not just in the United States, but literally in every country in the world, even very much in the BRICS. It's not as easy as just saying we want to leave the dollar and then doing it. The other thing I would point out is whenever we see these BRICS conferences and these headlines, it's always the politicians saying this is what's going to happen. I have yet to see any of the business leaders in these countries get on stage and say, wow, I am very excited to use this new BRICS currency or this new BRICS pay. I think this is going to be a hugely efficient profit-driving enterprise to switch what we've been doing and go to this new system that has never been tested or used. And at the end of the day, businesses are what drives economies, not politicians. Now, don't get me wrong. Politicians have a lot of power. Governments can enforce certain things. But I don't think the transition from the dollar system that we currently have, even in these other countries, to a new BRICS pay or a new BRICS currency or some new system that they agree amongst themselves would be peaceful from either an economic perspective or from a military perspective, to be quite honest. And I think in that volatility, I think the dollar would rise. And as you know, I believe that as the dollar rises, chaos abounds. And so I just don't see how this transition could ever take place without significant volatility.
Let's move on to talk about foreign holdings of U.S. Treasuries, because, of course, if you're the gold bug conspiracy theorist, you're going to say, well, what's really going on, Brent, is the reason that gold is rallying so much right now is that the central banks around the world, they do understand this. They're dumping the dollar. They're going to gold instead, man. That's what's going on. I read it on the internet, so it's got to be true. Probably a little bit of room to put different perspective on that. Help us out.
Well, so it's not that that's completely wrong, right? Central banks have been buying a lot of gold over the last 10 years, and especially over the last 3 or 4 years. And they have been buying more gold than they have for a long time. So, and you're seeing that reflected in the price of gold. But the reason I put this chart in here is to show that even though...
Which chart number are we looking at, Brent?
Sorry, we're on page 22. On page 22. It just shows that the foreign holdings of U.S. Treasuries has never been higher than it is today. So it's not as if there is a huge treasury strike by the rest of the world. But that said, I'm the first to admit that the central banks have been buying gold in addition to treasuries. And if you go to page 23, which is the next slide, you can kind of see that large foreign holders from a big perspective, it shows the largest holders of treasuries. And some of the biggest ones, has been pointed out, are these tax havens: Belgium, Luxembourg, Ireland, the Cayman Islands, right? These are not exactly hugely populated countries that are known to have, enormous GDP and capital. So who are these people doing these buying? Well, the reason I put this in here is there's actually a reason that you see these countries like Belgium, Luxembourg, and Cayman Islands being large buyers, Because if you are a foreigner who wants to buy U.S. Treasuries, you have to do it in a vehicle that doesn't get you taxed. So many people may not know this, but if you are not a United States citizen, the United States is the biggest offshore tax haven in the world. That's where everybody offshore wants to put their money because they get a preferable treatment for doing so. But when a foreigner invests in the United States, if you open an account in the United States, you still have to fill out a tax form. And if you don't have a tax ID, then that firm, whether it's Fidelity or Bank of New York, they're going to withhold taxes if you don't, fill out this form that specifies what your tax status is. And the way they get around that is they invest in a vehicle in the Cayman Islands, in Belgium, in Luxembourg. And that vehicle then has a tax ID number and it's not taxed. And that is how those foreign entities or those foreign investors invest in the United States without being exposed to United States tax law. The reason I know this is the way it works is I have managed personally funds that do this. And, if we had a client one time who invested directly when we got the client, they were invested directly in the U.S. and they opened an account directly in the U.S. and they had huge tax withholdings in their account. And it was a nightmare to figure it out. And so what foreigners typically do is they will invest, via a Cayman entity, an Irish entity, a Belgian entity, and then that entity can invest in the U.S. and avoid all these tax problems. So that is part of the reason. I know there's a lot of conspiracy theories around why does a country like Belgium, why are they one of the biggest holders? Why is the Cayman Islands, a small island in the Caribbean, a huge owner of treasuries? But that is at least part of the explanation.
Okay, hang on a second, Brent, because if we're talking about foreign investors in U.S. Treasuries, you're absolutely right that they need to file Form W-8-BEN in order to tell the IRS who they are and where they are. But they don't have to be any place they're paying taxes as long as they fill that form out. Portfolio interest, including interest from treasuries, is non-taxable to foreigners in the United States, provided that they just fill out the registration form. So it seems to me that what you just described, unless I'm missing something, would really only apply to special case investors that for some reason just hate the U.S. government so much that they don't want to disclose anything to them, and to miss the chance to invest in U.S. Treasuries tax free because you weren't willing to complete the information on Form W-8. Boy, you must be really hiding something. Is the way that comes across to me. What our mutual friend Luke Groman has suggested is, wait a minute, what if what's really going on here is this is hot hedge fund money? It's the Cayman Islands. Those are also places that master funds for global hedge funds, global macro hedge funds are operating there. And he thinks what this means is those are not sovereign holders. Those are not countries like Belgium investing, through other entities. Those are hot money investors, the kinds of investors that invest in hedge funds that are likely to completely abandon their conviction and their strategy and, run the opposite direction and turn on a dime. He sees that there's more risk of volatility. It sounds like you think that it is money coming in through those same kind of offshore Cayman Islands kind of places, but it's more likely to be sovereign money coming in. So how do we know what money is actually flowing in through these potentially tax haven places?
No, I think I think perhaps the way I explained it did not come across clearly. I would agree with Luke that it is, these entities. It is either hedge funds or private equity funds or some kind of offshore entity funds in which individuals from around the world have invested, and then those vehicles have invested in treasuries in the United States. But my point is that the reason that's coming in from those countries is those are the countries that very wealthy individuals use to access United States markets. So I think what I'm saying is I don't know for sure the exact strategy that these entities are using. Neither does Luke, neither does anybody else except for those who are actually running the funds. But I'm explaining that is why these smaller countries are such large holders.
Okay, but I think we could all agree that if you just look at those funds, that category of hedge funds and so forth, their investing characteristics, of course, are unique to whoever's running the fund, as you said. But on the whole, their style is rather a lot different than, say, central bank managers of holdings. So we're talking about a totally different kind of money. And when people say that you can't say that foreign holdings of U.S. Treasuries are collapsing. They're not. We're actually at an all-time high. You got to look at the data. Well, wait a minute. If I look at page 23 in your deck, what I see on the red line, I wouldn't say quite crashing, that's Chinese holdings, or the blue line, Japanese holdings, is downtrending, not crashing, but definitely downtrending pretty hard. And opposite direction, the increase that's occurring at the same time in terms of those hot money sources, Cayman Islands and so forth. So it seems to me like what's really going on is central banks are, exactly as Luke had suggested, very actively divesting their interest in U.S. Treasuries as a central bank reserve asset. But the data is being clouded by the fact that at the same time, for whatever reason, hedge funds in the Cayman Islands and other hot money sources who have very, very different characteristics in terms of how long it takes them to panic out of a trade, those are the guys that are making up the difference, to the point that when you just look at the simple data, which is the chart that we looked at on page 22, it appears to give the opposite conclusion from foreign central banks are selling off their holdings. But page 23 reveals that they really are.
Well, it's funny because we're going to talk about that in a couple slides ahead. But the one point I would make, Eric, is that for years, and you know this, and for people who don't know this, I started talking about this dollar milkshake theory back in middle of 2018. And in January of 2019, Eric's conference in Vancouver was the first conference I spoke about it publicly. And one of the arguments that I made at that time was that wealthy foreigners around the world would choose to invest their money in the United States as opposed to domestically, and that you would see increased investment in the United States in the years ahead. Many people said, no, that has already happened. The investment has already taken place. It is no longer going to take place. But I kind of took the other side, and I think this chart does a good job of showing that entities, smaller entities, and very wealthy individuals who invest in these vehicles in these offshore havens have made up that difference to your point, have made up the difference in the central banks. And therefore, the overall holdings by foreigners of U.S. Treasuries has continued to rise.
Okay, so we're very much in sync on what's happened. It begs a really obvious question to me, which is, okay, hang on. If what seems to be going on is central bankers around the world who, a lot of people, although I don't agree, frankly, a lot of people seem to think of central bankers as the ultimate gurus on sovereign debt and, knowing where it's headed. Those guys seem to have all en masse gotten bearish on the U.S. dollar, and that's inspired hedge funds to want to buy it. What's the rationale? Why is the hot money suddenly so interested in something that central bankers are stepping away from?
You have to understand that it's a relative world. The money has to go somewhere, right? And if you don't want to put all of your money into equities, and you don't want to put all of your money into gold, and you don't want to put all of your money into Bitcoin, you probably still do want some exposure to fixed income. Many large investors out there, despite the fact that many people think that fiat loses value over time and bonds are a horrible store of value. It's not that I disagree with those, but there is still huge demand for fixed income around the world from a number of different sources. And if you're going to pick a fixed income, why not pick the one that is in the United States and is paying a better yield than just about anywhere else? So I think that explains a lot of it.
Okay, Brent, I think I've got it now. So what you're saying is that central banks really are selling off U.S. Treasuries. That's pushing the price down. At some point, the price gets down to the point where there's a value trade there. And smart guys running hedge funds say, hey, we can see the mechanism here. We know it's political, but we know that these treasuries are a bargain. Once it gets down to this price, meaning this high of a yield, well, we know this is a bargain. We're going to grab it. You think that basically the actions of central banks that are politically driven are creating bargains in markets that smart guys running hedge funds are scooping up?
I think that partly explains it. And this is kind of the point I was trying to make. Again, back in 2019, people would always ask me, who's going to buy the debt? Who's going to buy the U.S. debt? And I said, the whole world will. And I think this chart does a pretty good job of showing that foreigners are buying the U.S. debt.
Page 24 breaks this down some more. What's going on there?
Well, so I wanted to point this out because I think a lot of times I will hear, since 2014, foreigners are no longer buying U.S. debt. And this is hailed as some, great schism in the markets that is going to lead to the death of the United States or the fall of the American empire. What's going on in the next 3 or 4 slides is to show that this has happened in almost every major country. So it has happened in Switzerland. And then if you go to page 25, it's happened in Austria, it's happened in Belgium, it's happened in Finland, France, Germany, and the Netherlands. You go to page 26, it's happened in Greece, Ireland, Italy, Portugal, and Slovenia. And if you go to page 27, it's happened in Australia, Czech Republic, Denmark, New Zealand, and Sweden. So again, you have to remember this is a relative world. Capital has to flow somewhere. Now, if foreigners were selling bonds from the United States, and they were actively putting it into other countries, then I would say, holy cow, maybe that's something that really needs to be concerning for the United States. And it's not that it isn't concerning for the United States. It's just that it's not a uniquely American phenomenon. This is a global thing. And it's because it's a relative game and capital is going to go to one of the players. You have to understand that it's not just happening to the United States, and it's happening to many countries around the world.
Let's move on to page 28, because I think as we look at a specific nation like China, there's more insight, at least to my eye here. If I look at that peak of Chinese holdings, around 2013 or so? If I just think mentally through geopolitics, I feel like I'm looking at a slide of U.S. foreign relations with China here. Oh, it's a Treasury holdings slide. I see. It's a finance slide. From the shape of it, I thought it was something else. Seems like there's a correlation there.
Yeah, so this chart is the Chinese holdings of U.S. Treasuries. And you've seen many charts like this, either with China or Japan or Saudi Arabia. Now, where Japan has actually added treasuries, a lot of times you will see these charts where showing that China and Saudi Arabia have dramatically decreased their U.S. treasuries. Not only have they not been buying as many going forward since 2014, but they've actually been selling since 2014. And you can see that it actually really picked up speed around 2020, after COVID, when the government lost its mind and started printing all this money and yields rose. And because people were not buying treasuries, yields fell, or yields rose, and then treasuries crashed, right? And then people sold a lot of them, or countries sold a lot. Now, this is China specifically. But here's the thing that I want to point out with regard to this chart, that many people either don't know or think they know and are incorrect. And what I mean is these charts do not reflect the number of bonds held. These charts reflect the value of the bonds held. The form that goes into the data, the data that goes onto these forms that then gets into the U.S. Treasury, that then go into making this chart. If you go to the next page, on page 29, it explains what that data comes from. And that data comes from purchases, sales, and fair value changes of long-term securities. The reason this is important is because while there have no doubt been some treasury sales by Saudi Arabia and China over the years, that is not what that chart is reflecting. That chart is reflecting sales, but also change in fair market value. And the reason you see such a dramatic fall starting around 2021 is because that is when interest rates started to rise. If you go to page 30, the white line is, I've zoomed in on 2021 until 2024. The green line and the aqua line, that is the price of the 30-year U.S. Treasury and the 10-year U.S. Treasury. And while a lot of people will look at that chart, the white chart, and say, wow, holdings have fallen by 20 or 30% over the last couple of years, China is doing a fire sale of treasuries. No. What has happened is as interest rates rose, because the Fed took rates from 0 to 5%, and the long bond went up as well, or the long rates went up as well, treasury prices fell 20 to 30%. And you can see how it tracks almost month for month with the price of those bonds. Now, unless you think that China is day trading U.S. treasuries, this chart pretty much shows that a lot of that fall is due to the change in price. Now, the other thing I'm going to say before I forget is I have had many people tell me that is incorrect, Brent. This chart is reflecting sales. And before anybody gets crazy and says, I don't know what I'm talking about, I have spoken directly to the U.S. Treasury about this on more than one occasion. I have emails from the U.S. Treasury confirming that I have this correct. And I have spoken to them about how they actually gather the data that then goes into the Treasury report that then ultimately gets put into these types of charts. And I'm telling everybody, just for absolute clarification, these are not nominal. These are current market value of the bonds.
Okay, Brent, this seems profoundly important to me because I don't think there are many people, including in pro finance, who fully understand what you just said. It seems to me, since you do understand it, there's a really great opportunity here for you to make your own chart by grokking and processing this data and saying, show me this, but also show me an adjusted version if you back out the effects of interest. You know, if you look at what happened to the price, because you know you've got market data for every single day, what the price of those treasuries was. If you just take the price out of it so that you turn this into a nominal chart by using the price to calculate the nominal data, you could plot the actual nominal chart that's showing this really in number of bonds and get the chart that the other people think they're looking at, put your name on it, and get famous. Have you done that yet?
I have not done that because while what you say is certainly possible, I just haven't gotten around to doing it. But one thing I would say is that there's already a challenge that I know that will come out, and they will say, yes, Brent, but a year and a half, I don't remember the exact date, sometime in late 2022 or 2023, a change was made, and they went from the old form. I think the old form was called the LT form, and the new form is called like the SLT form or something. And the new SLT form, this is the Treasury International Capital Group that collects this. On the new form, they actually have it broken out. So it used to just be one number that included sales, purchases, and valuation change. Because they wanted to kind of break it out specifically, kind of like what you and I are talking about, they changed it. So now there is, when people fill out these forms, there's a section for sales, there's a section for purchases, and there's a section for valuation changes. You got to remember, these are government agencies that are doing this. And it's kind of a voluntary, they send out the surveys to all the big custodians. And then the big custodians, I can't remember if it's on a monthly or a quarterly basis that they update these. They have to fill them out and send them in. Now, I'm not trying to make fun of anybody, but this is not the CEOs of these custodians filling out these forms, right? And the Treasury, I've spoken to the Treasury about these forms. These new forms are only like a year and a half old. They do not have high confidence that the forms are being filled out 100% accurately. Again, this shouldn't be surprising. You know, inefficiencies in government agencies and things don't always work out perfectly. And they said it's very possible that sometimes when the forms are being filled out, they're filling them out as sales when really they're just looking at the change in valuation. But again, I just want to be absolutely clear. Regardless of whether or not China is selling treasuries, which I am sure they have sold some, this chart does not 100% reflect sales. But this chart that I'm showing you here makes it pretty clear to me, and it was pretty clear to the people at Treasury that I was speaking to, that this chart does in fact reflect change in valuation of Treasury bonds.
Brent, let's move on to a subject that is near and dear to many of our listeners and to me. That's gold on page 31. We look here at a textbook cup and handle pattern, very nice clean breakout. But hang on, at least as I chart the target of that cup and handle formation, it's around 27.25. Okay, we're there, exactly. It seems like at least the initial target, we already made it. Does that mean it's time to dump your gold and expect it to be all downhill from here?
I knew you were going to ask me this question, Eric. And when I was thinking about it earlier today, I was laughing because I already know how this is going to be received by those in the gold community who think you should only own gold. So you know as well as I do that I have been bullish on gold for years. Owning gold in the portfolio has been a key part of my whole milkshake theory. One of the most controversial parts of the milkshake theory when I first started talking about it was that the US dollar would rise versus its fiat peers, but yet gold would still rise as well. The strong dollar would not necessarily negate gold rising. And so gold has done phenomenally well. You know, it broke through this cup and handle formation that you mentioned earlier. I actually think that while I would not recommend selling your gold, I do not think that people should, rush out and just because the price has gone up, start dumping it. I don't think that gold is going to quote unquote crash, but I bought puts on it a week ago when it was at 26.75 because I think it's just come a long way. It's up like 35% for the year. That's pretty darn good, right? And I've been doing this for 25 years now, and markets don't go in straight lines. So I think it's probably due for a pullback. Again, I don't think that people should go out and sell their gold. But don't be surprised if this pulls back a little bit. Now, having said that, it will not surprise me at all if gold goes to $3,000 in the next year, or maybe 3,500. But I think about gold much differently than most people. I think there's a lot of people who own gold as a way to get rich. I own gold for insurance. I honestly don't even really care whether it goes up or down. I'm going to own it regardless of whether it does or not. But looking at this chart, this is a pretty darn nice looking chart. It's hard not to look at this chart and get a little bit excited. I just think it's gotten a little bit ahead of itself.
Brent, let's move on to page 32. Does this give us more insight into why you've been cautious?
Well, yes. And so this is a chart that, and it's funny, like a lot of things, people will look at the same chart and come to two different conclusions. What this shows is the price of gold charted versus the commercial short position on the commitment of traders. Now, the commercials, they're the big banks, the bullion banks. They take the opposite side of the speculators. And I'm showing I think this is about 10 years of this chart. And in general, as the price of gold rises, the specs typically pile in. The commercials take the other side of that. Historically, when it has gotten this extreme with the price to the upside and the commercial short to the downside, you will oftentimes, and you can just look at this 10-year history, it's pretty clear that there's an inverse relationship and it will eventually revert back. Now, there's a catch, is that it is possible that gold keeps going up and the commercials are the ones that have to cover their shorts, and you get an epic short squeeze and gold goes to 3,000, 3,500, whatever the number is. I'm not sitting here and saying that can't happen. I'm just saying historically that is not what has happened. And so this is one of the things that gives me caution. When I look at all the specs that have piled in, when I look at the commercials that have probably their second biggest commercial short position or net short position in history, when I look at sentiment in the gold market, and when I look at relative strength in the gold market, everything is near its all-time high. Now, I don't like buying anything. I don't like buying Apple at an all-time high. I don't like buying NVIDIA. I don't like buying oil. I don't like buying gold, silver, or anything else at an all-time high. So that's part of the reason why I am cautious.
Okay, hang on a second, Brent, because what you said a minute ago, I've always thought of as a fallacy or a myth in the gold bug community, which is when people say, you know what's happening? Those commercial shorts, they're finally going to pay their dues for their evil position or whatever people think. They're going to get squeezed out, and that's what's driving the big rally. The way that's always been explained to me by the grown-ups in the gold community is to say, no, you don't get it. The commercial shorts are not speculative traders. They're not in a short situation where they could be squeezed. Those shorts are hedging long positions in physical metal, or they're hedging something else, and the bank is already delta hedged. They can't be squeezed out of a short position because the short is just a hedge on a long, and they have no market exposure when the market goes up and down, and that's just a situation where gold bugs are confused and don't understand how the market works. That was what I was expecting you to say, but you didn't say that. You kind of said the opposite. So what am I missing?
I don't think you're missing anything. I'm actually glad you brought that up and pointed that out, because I think there is this big theory out there that this massive short position is just, it's a ticking time bomb. And the point I wanted to make is I cannot 100% refute that, but it doesn't typically work that way. And the reason it doesn't typically work that way is exactly for the reason that you just explained. The other thing I would say is there's a lot of people who will say that the shorts are just the producers who are hedging their production. And the thing is if you actually break this down into a disaggregated way, you will see that the producers are only about 20% of the short position. So in other words, when some people will say the commercials are just the producers hedging. Well, that is not true. Only about 20%, maybe 25% of the commercial short position is producers that are hedging. So to your point, I think the best way to summarize it, because of the reasons you said, there is not this massive, short position that the bankers are going to get squeezed. It's not that it couldn't happen in any circumstance. It's just that it typically doesn't for the reasons you said. And it's not just hedging of production by the actual miners. And so, again, I think if people just remember, markets don't move in straight lines. And the more something does move either up or down in a straight line, the more it is susceptible to extremely fast snapbacks, whether to the upside or to the downside. And so when you see a market that's going straight up, that is always a time to start looking of how to protect the gains that you've made. It doesn't mean you have to sell. It doesn't mean you have to give up on the trade. It doesn't mean that you hate gold. It just means that, hey, you've had a really good run. Let's be prudent.
Brent, if the price of gold was $200 lower 1 week from today than it is right now, would that cause you to dive on it, buy the dip, got to take advantage of this opportunity to lever up? Or is that a signal that says, okay, wait a minute, the direction's changing. This could be a medium-term thing. It's time to increase the hedges here.
Well, I think the answer sort of depends on why did it come down $200. So the way I
just
would
look on the internet, you'll get a clear explanation that that has to be right.
I think that this is the way I'll answer that. If you do not own any gold, you should absolutely own some. And so if you don't own any, it doesn't really matter what the price is. You should buy some. Now, hopefully, you've been listening to MacroVoices for several years. You and I have talked about this several times. You've talked about it with many other guests over the years. Hopefully, your listeners already own gold. I'm guessing that most of them do. So if you've already bought gold, whether it was last year, 2 years, 5 years, or 10 years ago, you don't really have to buy more now that it's all this way up here, right? And if it does pull back and you have some cash, then maybe if you want to increase your exposure, perhaps go for it. So this is a long way of saying I already own gold, so I don't have to go buy more of it if it pulls back. But if it does pull back, I will most likely be looking to add. I'll have to wait and kind of see when it gets there.
Now, going back to page 31, as we already discussed, if you understand technical analysis and where a cup and handle pattern would normally target, boy, it's awfully hard to add or put new money to work on the long side of gold on page 31. Feels like you kind of missed the trade here. Ugh, nothing you can do about it. Wait a minute. Page 33. Looks like the same chart, but this one hasn't really moved yet. Does that mean that silver is not as strong as gold, not the best choice because it hasn't moved yet? Or does it mean it's a better choice because it's about to move and follow gold and move much higher?
Well, there's a couple things going on here, Eric. Now, the interesting thing that, I have to tell you, when I was here on your show in May, was kind of when silver had just started to break out. It was right under $30 at the time. And I had bought some puts because I said it was going to pull back, and it did pull back. We made some money on those puts. And everybody was all over me saying, you're going to miss the trade. This is the trade of the century. If you don't own silver now, you're never going to own it. And what I said at the time, and if people want to go back and find that episode, there was a slide that went with it. I said, if silver can break through this resistance at kind of the 30, 31 level, and if it goes up to, 33, 34, 35, and then pulls back to 30, that's probably the place to buy it, because now, it could really rocket higher. So what I am looking for is for silver to come back. If it bases around 30, then I will probably buy some silver. If it goes back to 29 or 28 and, continues on down, well, then I'll just wait for 30 again. Right. And so there's a lot of people who for some reason think I have to own silver, and I don't own silver, and I don't have to own silver. And if I don't want to own silver, I don't have to own silver. But I do think that this is setting up for a fantastic trade if it can. If I don't like how far. I mean, it went up like 5 or 6% just on Friday. As it kind of busted through that resistance. I would like it much better if it kind of pulled back and kind of based for a while around 30. I don't want to see it rocketing higher, and I don't want to see it crashing back below, because I think neither one of those I think would be healthy. I think what would be very healthy is if silver pulled back to around the 30 level, kind of based there, kind of worked off some of the commercial short position that it has. You can see that on the second slide as well. And then, you could perhaps see the same type of phenomenon that you saw with gold.
Brent, something that really fascinates me is that if you talk to the gold bugs and the silver bugs, their biggest complaint for decades has been, we'd be making so much more money, but it's those stinking central bankers, because there's a conspiracy, there's a cabal, they're manipulating the market. It's market manipulation. And the big evil fear or enemy here is market manipulators. Market manipulators are bad. Stay away from markets that are manipulated. Okay. Is Wall Street silver, that's the silver bug, their side, very actively and obviously engaging in market manipulation over this crowdsourced internet collaboration? That's what they do. That's their purpose for existing. How is that not market manipulation that would cause you to step away from an asset?
Well, I mean, in short, it is, right? Now, the people on the internet clearly don't have as much power as a central bank or a government. So it's not to the same extent. But in short, to answer your question, it of course is. But what I find even more interesting about that whole phenomenon is that for years they were complaining that the central banks were manipulating the price of gold lower by selling it. They did not like that. They didn't think the governments should be involved in the markets. The markets should be left alone. But now that the central banks are buying gold and pushing it higher, now it doesn't seem to be a problem. I haven't heard one person complain that the central banks are manipulating the price of gold higher by buying so much of it. So, I listen, I can't sit here and say that for sure that there's not been a time where governments have suppressed gold. Clearly you can look at, there's historical documents that show that it has been a matter of policy at certain times. But I'm not somebody who thinks that every day that gold falls, it's manipulation. And if they are manipulating gold lower, they sure as hell have done a really bad job of it, because it's sitting at $2,700 right now.
Brent, I'm shaking in my boots for page 35. Normally, I talk to my guests about this and that, and I said this once, and they said that once, and occasionally we make a mistake and somebody holds us to account. But you came to this interview prepared with evidence of what you really said and what I really said. So what's going on here?
Well, I'm basically just saying that you asked me because I think when I was on, gold was near its high, and you said, well, would you short it here? And I said, listen, I'm never going to short gold. The reason I wouldn't short gold is because you could literally wake up tomorrow and gold could be at $5,000. If war breaks out, or if some central bank fails, or whatever it is, gold is an existential trade, right? And the reason it's always hard to kind of sell gold on a breakout or when it's going up, the reason it's hard to sell a spike in gold, because it is such an existential trade. A lot of times the reasons gold is going up is fear, uncertainty, doubt of what's going to happen in the future. But the point I would make is that it doesn't mean that you can't take some profits once. Listen, if you have a 10 or a 20% gold allocation and it goes up 30% and you sell 4 or 5%, you still have an extremely large position in gold, right? So I'm not against doing something. Now, I wouldn't sell all my gold. Of course, I would not sell all my gold. And the other thing I would say is that, with the dollar going higher, a lot of people have always said to me, the dollar going higher, you must think the gold's going lower. And no, that is not the case, right? My point for 5 or 6 years has been that there is nothing more long-term bullish for gold than a strong dollar. Because as the dollar goes higher versus its fiat peers, it causes chaos. It causes breakdowns. It causes crises. And gold is a beneficiary of all of those things. So you don't have, but for some reason, people just hate this whole dollar milkshake where the dollar is beating its fiat peers, and that they just cannot accept that I think that the dollar can stay strong and that gold can go up along with it. So I would just say, you should all absolutely own gold, but you don't have to hate the dollar in order to own gold. The dollar has so many advantages over its fiat peers that you're really doing yourself a disservice by ignoring it. And I'll wrap it up on this, Eric, is the reason I focus on the dollar is because the dollar is the primary variable, in my opinion, in almost everything in macro. And if you get the dollar wrong, it's going to be very hard to get your portfolio right. And the other thing is that every financial crisis of the last 25 years has coincided with the dollar going higher. The reason for that is also every crisis for the last 25 or 30 years, almost everyone had some form of a currency carry trade as a determinant of that crisis. And so in that respect, there's nothing more important than fiat versus fiat. Because we live in an age where fiat is being debased at an increasingly rapid rate, many people think that fiat versus fiat doesn't matter. I am here to say that there is nothing more important than fiat versus fiat. Because when one fiat currency moves dramatically versus another fiat currency, really bad things happen in capital markets.
Brent, let's move on to page 37 in the S&P.
I'm going to say something that I've said pretty rarely or pretty frequently that I've been here. And before I answer this, I'm going to say part of the reason that I kind of sound the same when I talk is that my strategy has kind of worked out. I haven't had to change my story. My story for several years is that I'm going to be long U.S. equities, but I think they're going to be susceptible to terrible drawdowns along the way. I'm going to own short-term fixed income because I think rates are going higher. So any fixed income we have is going to be very short-dated. And I'm going to own gold because I think for a number of reasons, gold's going much higher. And I'm going to have some hedges, some either volatility hedges or equity hedges to protect against these dramatic drawdowns. And that's kind of where we're at today. Equities have had a really good year. They had a hard drawdown in late July, August. I think it's very possible. Again, this isn't, I don't know for sure, and I'm not predicting a crash, but with all that's coming up over the next 2 or 3 months, with all the uncertainty surrounding the Middle East, surrounding the U.S. elections, surrounding Taiwan and what's going on in China, I think the markets are very susceptible to a very hard and quick drawdown. So while I think equities are going much higher over the next couple of years, I am prepared for some downside volatility over the next 2 to 3 months.
Brent, page 38 seems wicked important to me. I'm going to resist the temptation to give my interpretation of this chart because it's your chart. Hit it.
Again, this kind of goes back to the overall theory. Back in 2018-19, I thought that this 40-year bond bull market was going to end. I thought interest rates were going to rise. I thought as interest rates rose, that would put pressure on the dollar to move higher. I thought that would help draw capital into the dollar. And, that's what we've had. We've had a pretty significant breakout in 10-year U.S. Treasury yields. Now, they've kind of gone sideways for a year. Unless we have some kind of a major risk-off black swan type event, with the budget the way it is, with the amount of money that the government's going to spend, I expect yields to kind of stay at these levels or go higher.
Now, when you look at this from a technical analysis standpoint, a lot of traders would say, okay, you broke out of a channel. The likely next move, or the textbook move, would be for the price to drift back down to touch what used to be the resistance line, turns into support, and then you see the rally take off from there. If you're used to looking at daily charts, you see something like this and say, oh yeah, in the next few weeks to a couple months, it'll probably come back down to that white line. Well, hang on a second. This chart is on a different scale. If you just imagine drifting back down to that white trend line, touching it, and then moving higher, that would be, it's going down for the next 5 years. So is that the right way to think about this? Are we maybe looking at an initial breakout that's going to come back down and retest what was previously resistance as support?
Well, listen, that could certainly happen. And I know a lot of people who not only believe that, but have that trade on. I do not have that trade on. Here's the reason I don't have that trade on. That is not my base case. But if that does happen, if yields come back down that fast and that hard, it probably means a lot of dislocation in the market. If there's that much dislocation in the market, then that I would imagine that risk assets are falling. And because we have a lot of T-bills and a lot of short-term fixed income, and we have dry powder, and we have hedges on our equities, should that dramatic dislocation in risk assets fall, I would rather play it by buying things that are distressed rather than playing for this to happen directly.
And let's briefly touch on commodities, page 39.
Well, I just threw this in here because I love long-term charts. And I just find this chart fascinating, Eric. This is like a 30 or 40-year chart. And, it shows equities have gone up, or those commodities have gone up and down and up and down, but they're basically the same place they were when I was in college. Now, certainly, things like gold have broken out, but overall, the commodity index is right where it was when I kind of was, just starting to learn what all this stuff was. And so I think there's been a lot of people who have been in the, fiat's getting debased, just buy hard assets and everything's going to work out great. And I think they've been in that trade for 2 or 3 years and it just hasn't worked out yet. Now, I'm not saying it's not going to work out. And in fact, I think that, in the years ahead, commodities will probably do good. But it's not guaranteed. And I don't think it's as simple as, central bankers are going to print money, so buy hard assets. And I think this chart does a very good job of showing that.
And let's briefly touch on oil.
I put this in here because when I was here in May, we talked about oil. And I said I thought that it was probably going lower into the fall. That's kind of what's happened. And I think that probably continues lower. Unless we have some kind of a military flare up in the Middle East, which is obviously very possible. I think that, oil probably languishes around 70 and perhaps even goes into, the 60s where it was a month or so ago.
Brent, I have to agree. I think there's plenty of room for it to go down unless it goes way up because of stuff that we can't predict. I'm flat as a result. Brent, as usual, I can't thank you enough for a terrific interview. Before I let you go, I want to suggest to our listeners who are not familiar with the dollar milkshake trade, just go to our homepage, MacroVoices.com. In the search box, type in dollar milkshake. You'll find Brent's previous interviews where he explains the whole theory in more detail. Brent, before we wrap up here, please tell our listeners where they can follow your work and what you do at Santiago Capital.
If anybody's interested in following what we do in more detail, if you go to page 41, I've kind of laid out the 3 different ways that people can either get in touch with me or kind of follow my work. Santiago Capital, I'm a registered investment advisor. I'm regulated by both the SEC and the NFA. It's basically a wealth management firm. I've got a number of high net worth families and individuals who I do overall wealth management for them. We also do a weekly show. We call it Milkshakes, Markets, and Madness. You can find that on YouTube. You can click the link on this slide, which will take you there. And then finally, a friend of mine and I started probably about 3 or 4 months ago, a research service called Macro Alchemist. And if you click on that link and go there, you can sign up and you can get access to the reports. We put out, 3 or 4 reports a month. Some of them are, 10 or 15 pages. Some of them are deeper dive and are 40 or 50 pages. But it's a little bit more deeper dive into the analysis that we do when we're kind of thinking about markets and thinking about trades.
Patrick Ceresna and I will be back as Macro Voices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, great interview with Brent. Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Brent's picture saying looking for the downloads. Now, Eric, let's get to crude oil, starting with the EIA inventory.
EIA printed a giant build of 5.5 million barrels of crude oil, Cushing, Oklahoma drawing down 346,000 barrels, gasoline building 878,000 barrels, and distillates drawing down 1.1 million barrels for a net petroleum build of 5.3 million barrels. Now, the experts, all of the smartest experts, assured us at the end of the pandemic that there was simply laws of physics, immutable laws of nature, which commanded that there was simply no way that the U.S. petroleum industry could ever top its pre-pandemic U.S. production record around 13.3 million barrels per day. Well, guess what they just printed this week? 13.5 million barrels. So I want to take a moment to salute all of the men and women in the U.S. oil patch who are our listeners. You guys are kicking ass, and you're proving the financial analysts wrong. So keep on kicking ass. We need that oil. I also want to acknowledge that my long-held view that there will be a global energy crisis by the late 2020s is based in large part on the analysis of people who previously said that this new record in U.S. production was impossible and couldn't possibly happen. So this begs the important question as to whether or not my analysis is flawed by the use of incorrect data. To tell you the truth, I'm not exactly certain. I'm still generally convinced that we are headed toward that energy crisis, but it's very important to watch this because I was not expecting it, and I'll definitely say this much. The key determinant of whether or not that energy crisis that I predict is going to happen or not is going to be whether or not the U.S. shale patch, the U.S. oil patch generally, can hold up current production levels and even increase them from here. It is the prediction that they will not be able to upon which that gloom and doom prediction of mine is based. If it turns out that the U.S. oil patch keeps on kicking ass, well, then I guess I could be wrong. In the here and now, I still think that unless you have inside information on the geopolitical front, directional trades in crude oil are risky here. I'm flat in my own account.
Eric, you're absolutely right. Production is up. Spare capacity is there. A lot of things that have been bear themes for crude oil, and that certainly has contributed to the bear market. It's been the July to September sell-off. But one of the things that we continue to see is that every one of these bad headlines, oil temporarily sells off and then bounces. That to me is showing signs that we've found some sort of fair value zone for oil, and the support lines are establishing themselves. Now, that doesn't make it a new bull market, nor have we seen a bull breakout in crude. But at least at this stage, we have a support line consolidation area where we can evaluate whether or not it acts as a pivot level for the next trend move. Now, if we see continued resistance in the $72 to $74 area and crude oil reversing and breaking down, it could theoretically still have another leg down. And that's why I think that the 72 to 74 area is going to be key, because of the bulls would at this stage need to keep sustained price action up in the mid 70s to start showing technical signs of a potential bull reversal. And so we're trading right at a very critical level. Now, Eric, let's talk equities.
Well, as I've said before, I'm convinced that the Fed has become political, even though they claim not to be, and I think that they're going to do all that they can to avoid a big market sell-off before the election. I don't have a strong fundamental view because I don't think it's economic fundamentals that are driving this equity market.
S&P 500 quickly went for a test towards the 5,800 area, but it's too premature to be speculating that this is already a major top. They have that round number 6,000 on the above, which is going to still act as a bit of a magnet, but really it's likely now at this stage that the market stays in this pocket going into the big earnings releases next week. And when we really get that in the jobs numbers, that could spur a pre-election move. Will that be to the downside? I think that the Mag 7 earnings are going to be the ones that decide this at this point. Now, Eric, let's touch on the U.S. dollar.
Last week, I said the key signal to watch for was a break above 104 on the Dixie because that's been a key technical level for years now. And this week, we got it, with the Dixie at 104.42 as I record early Thursday morning before the U.S. Open. We haven't seen quite enough upside action yet to convince me that a continued rally can be sustained above 104, but that seems to be where this market is headed, and it's no surprise given the current geopolitical risk backdrop.
Yeah, Eric, it's been a robust move. I want to specifically highlight on page 5 that chart of the euro US dollar, because what we continue to see is that the euro has materially broken down, and this is where the US dollar strength is predominantly being driven. We have now re-entered back into the trade range of the entire summer and really nullifying any bull trend that the euro was trying to establish, and puts us back into the meat grinder of a sideways currency market. And really, it's been a multi-year trade range, and we haven't seen that high conviction currency move yet. And at some point, the trend will emerge. Will it be a strong U.S. dollar that is the one that prevails is something that we have yet to see. At this moment, especially in the pre-election period, it's a fair assumption that the next few weeks will at some point have this euro bouncing back and consolidating into waiting for those election results. All right, Eric, let's move on to gold.
Well, I remain super bullish, but it's important to recognize that technical indications are overbought in several timeframes. The upside target for the more than a decade-long cup and handle formation was 27.24, and we're already above it. Quite a few posts on X and elsewhere have suggested that investor sentiment is that a Trump win on the election is super gold bullish. But frankly, I think that's personal political bias that's entering into the discussion there. I could easily form a coherent counterargument that a Harris win is far more gold bullish than a Trump win. But for now, the market seems to disagree.
Well, Eric, there's no denying the prevailing bull trend that continues to be very dominant, but I'm naturally a trader, so I like to sell rips and buy dips. At this stage, gold is starting to get to a stage where I think that the asymmetry of putting on new positioning in gold is got, at least in the short term, some limited upside potential for what could end up being some sort of a mean reverting correction. When you have this many people so decisively bullish, the market often plays the role of the great humiliator and shakes some of the weak hands out of the market. Will we get one of these corrections is something that I think inevitably happen. I want to move on, though, to page 7 where I have the silver chart. I want to cover all these different precious metals. And silver broke out of a very important 6-month range. And now we have a scenario where silver could easily still make a move to 35 to 37. If we have that kind of a move, that could allow gold to still potentially make it up to 28 or 2,900 on the upside, while the entire precious metal stays short-term bullish. At this stage, there should be a little bit more bullish follow-through here, and we'll be looking whether or not resistance starts to develop in the next couple of dollars higher. I wanted to just touch on platinum on page 8. In particular, this is one of the precious metals that has been a laggard, and but now what we have seen is it has broken out those July and September highs, and now it's certainly approaching those May highs near 1,080. And so will we see a new follow-through on platinum, and is this a new bull phase here? Well, certainly starting to look like that as all the precious metals are breaking out together. And the last one is a palladium chart on page 9, where you can see that it was in a trade range all year, and we now had a bull breakout that has definitively now started some sort of a new bull trend. This is probably one of the more interesting charts that seems to be at the beginning starting blocks of a potential new trend. So let's see whether this can continue. All right, Eric, let's move on to uranium.
After an epic 40% rally off the September 6 lows in some of the uranium mining shares, we're finally seeing that predictable pullback. I say it's a buy the dip, and this uranium market is only just getting started. But there are still gaps on the charts well below the market. So don't be surprised if this pullback develops into a proper correction before the bull market resumes.
Yeah, Eric, to speak to that uranium equity rally, on page 11, I have that uranium ETF URA. And what you can see is that extraordinary 1 month rally that we've seen that has traded right back up to the summer highs. Now, the question is that as we see these pullbacks, will the bulls continue to demonstrate bullish characteristics of buying dips and see support lines forming quickly above moving averages that are the typical kind of price action that you would see that is setting up for continuation patterns, particularly in the case of the URA. I think that watching pullbacks down towards $29, $30 and whether the bulls can hold these kind of retracement areas and turn it back up. Though, Eric, I wanted to briefly touch on page 10 on the Sprott Uranium Physical Trust and just showing the actual price of uranium. While these uranium stocks that reacted in a big way, we haven't seen spot uranium actually get hot and start moving. And so when we did see money flow going into the physical trust, but that has met some material resistance as it's just traded back to the net asset value of its underlying holdings and simply doesn't have room to break out in a meaningful way until we see actual U308 start to participate. And finally, though, I wanted to just touch on the 10-year Treasury and note futures. And so we've seen, obviously, that big move in the 10-year yield, but we're now actually at a very important inflection point. Obviously, there's increasingly large amounts of people coming out on the bearish side of bonds and expecting yields to go higher. We're at the stage where we've now 50% retraced the May to September rally that turned on the FOMC rate cut. And so we're at a stage where if this was simply bonds kind of taking out that dovish enthusiasm that was built up in the third quarter, the question now is this now going to be a fair value zone where we see bonds stabilize and start to settle in these mid areas, or will the bond bears prevail as this thing breaks all the way back down to year lows? I'm sort of in the camp here that we should see some sort of oversold short-term lows, and some bounces back are likely. I'm not bullish bonds where I think we're about to see new highs or fresh lows on the year for yields. It wouldn't shock me if we got from this 111 area on the 10-year note futures up to 112 or 113 on the upside.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this Research Roundup, you're going to find the transcript for today's interview, as well as the slide deck that Brent shared during the interview and the chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @Eric S. Townsend. That's Eric spelled with a K. And you can follow me @Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.